Hello and welcome back to the Dibba podcast. I am very excited to have James Godrich with me today. James's expertise lies in numbers and analytics. He joined an investment management company in 2015 and has worked his way up the ladder to become one of their youngest fund managers. In 2020 and 2021, James was included in the Citywire Wealth Managers Top 30 Under 30 annual list of high-achieving future leaders. He currently manages an investment fund of over £100 million, and that figure keeps growing year on year. This will be a fascinating insight into investing, cryptos, and social media. Hope you enjoy the episode. James, first of all, thank you so much for coming on the Dibba podcast.
Thanks for having me.
How are you?
Yeah, very well. Very well, thank you.
You manage an investment fund of over £100 million. Sounds like a lot of responsibility.
Yeah, it is. It is. So I started running money roughly 3 years ago now. The fund's grown in size significantly from sort of roughly £60 million when I first joined the team to, over £100 million now, which is great. And we're really pleased with that. But I think you're absolutely right. It is a lot of responsibility. I am fully aware of that. I have family, friends. I know a lot of people who are invested in the fund, and it makes it real as well, which is really important. I think with finance a lot, it can kind of almost feel a bit faceless, and it can almost feel a bit like you're a bit distant from it, and it's numbers on a screen. And so I think it is really important to feel that kind of responsibility. It's worth saying as well that my money's invested in the funds as well, right? I'm bought in as well. So it is a lot of responsibility, but it's kind of a privilege as well, right? People are trusting you with their money. I think it's really important that we treat that with respect and that we honor that, I guess, really. Yeah. So it's something we think about. Yeah.
Yeah. Okay. The assumption is, and you've touched on it there slightly, is that much of investing is purely data driven. Is that the case, or does gut instinct come into it as well?
No, it's okay. That's an interesting question, because I think gut instinct to an extent, I think, is important, but it can't be the driver of the decision. What I think is most important is I try and let a process be the most important thing. So I read a book recently on the difference between skill and luck, and basically trying to work out when things are lucky and when things are skillful. So if you outperform in the investment markets, or if you, let's say you do buy crypto and it goes up, was that lucky or was that skillful? If Cristiano Ronaldo scores a free kick from 30 yards and it goes in the top corner, is that lucky or is that skillful? Like, there's so many aspects of life that we need to work out. Is it luck or is it skill? And I think there's a broad recognition that there is a large element of luck in investments. You are going to have times where you make the right decision and you get the wrong outcome. Equally, you're probably going to have times where you make the wrong decision and you get the right outcome. But what this book kind of concluded, or it was one of the elements of the book, is that if you are on the kind of skill end of the spectrum, then it's all about practice, basically. If I'm throwing darts at a board, it's pretty much skill, right? So I just need to practice it time and time and time again. If I'm on the luck element of the equation, it's actually more about process. Because in investing, there is an element of skill, clearly. Otherwise, anyone and everyone would do it. It's all about being aware that just because I've got those skills, I'm not going to get it right every time. And it's about executing on a process that allows me to understand, right, I've got it wrong, but why have I got it wrong? Or, was it actually the process, or was it just bad luck, or, this kind of thing. And so we really try and focus on the process of how we invest. So what are the things that we want to look for? Are there certain criteria, financial metrics? Do we want to make sure that we go and meet management? What kind of questions do we want to ask management? Do we want to understand about the customers? Do we want to understand about how they treat their suppliers? Do we want to understand about the environmental impact of that business? So what's the process that we go through as we get to learn about a company? And then when we get to learn about a company, what's the process we go through to say, right, is this a great company? Is this an average company? Is this a poor company? But then also, there's a question beyond that as well, to say, it's kind of first order thinking to say, this is a great company. It's second order thinking to say it's a great investment, because everything has a price, right? Yeah. So then you've got to go through the process of saying, right, how do I work out how to value this? And then how do I go through the process of making the correct decision of whether we then actually buy it, and in what size do we buy it? Do we buy 5% of the fund with it, 1% of the fund with it? The point is that I think that the key is about having a process more than anything.
Have you ever gone against that process and just gone, okay, I really feel that this investment will do well? The processes may not point that way, or the data may not point that way, but you've gone, no, let's just do it.
No, so we wouldn't do that. But what we would do, and what we have added, is we have added a section to our process that's titled gut feeling. So it's a long kind of document that we produce. Every time we look into a company, we produce a big long document that says, right, who are its customers, who are its suppliers, what do I think about all those things? One thing that we added fairly recently, because our process, it evolves, right? It's always going to evolve. It's going to change and evolve. We've not got it right. No one's ever got it right. So it will evolve. And one of the things that it evolved to was to add a line on saying gut instinct.
Yeah.
Because, it's got to say something, know, so but we will never let that drive the decision.
Yeah.
There is much more to the investment thesis than that.
Yeah, I guess the gut instinct or the gut feel could also be classed as high risk appetite.
Yeah, to an extent. I mean, it's not how we think that when you let those gut instincts and those emotions become the key driver of the decision, that's when you tend to make poor decisions. It's being able to step back and being able to say, like, right, let's actually process all of the information here. So there's a lot of research on this. It's kind of a little bit like behavioral economics, really, what we're talking about. Are we actually rational decision makers, when we allow that kind of gut instinct, that feeling, that emotion, make the decision? And I think it's kind of been proven is maybe not the right word. I'm not sure. I think it's been kind of proven, though, that as humans, we're not great at those kind of gut instinct snap decisions, generally speaking, in the financial world. So if you have a look at someone like Daniel Kahneman, so they talked about having two sides of the brain. So you've got the kind of like the side one. I always forget whether it's side one or side two, which is which. But there's the kind of side one of the brain, which makes the kind of snap emotional decisions and says, right, I need to jump out of the way of that train or whatever it is. I need to jump away from the animal that was hunting me, thousands of years ago. And then you've got the side two of the brain, which is the kind of rational part of the brain, which makes those kind of is able to think much more deeply about kind of complex issues. And if you allow that side one of the brain to take over from the decision making, it tends to make pretty poor financial decisions.
Yeah.
Let's say, as an example, right, if I put a snake in a glass box on this table, so it's a glass box, it's completely see-through, but I put a tea towel over the glass box, and I tell you to look at the tea towel really closely. I don't tell you what's under it. I tell you to look at the tea towel really closely, and then I yank the tea towel back. You're going to jump back. It will be your immediate reaction. You'll jump back and you'll go, "Oh my God, there's a snake there." That's your side one of the brain that's jumped back. But then your side two of the brain will go, "There's a glass box there. I'm in no danger. I could have stayed where I was."
Yeah.
Now, in financial markets, that gut feeling and that emotional instinct is often that jump back and go, oh my God, this is not good. Let's panic here. And it's often about actually basically allowing that part two of the brain to be the key decision maker and to be able to say, I know he's just yanked the tea towel back, but hang on a minute, before we do anything, let's just assess this situation. Hang on, there's a glass box. Yeah. So I've sat here and I've not moved and you've jumped back. And in the financial markets, that the example there is, let's say a company has relatively bad results or something like that. Your immediate reaction could be to jump back and go, I'm selling all my shares. I'm out. The market's fallen by 10%. I'm out. If I'm able to sit there and rationalize the situation and process it deeply and not let that gut instinct and that emotion be the key driver, then I might come away with a different conclusion to you. Yeah,
and I think you've mentioned to me that time in the market is essential to timing the market. And I think that was really powerful. Do you want to elaborate on that?
Yeah, so I'm not sure people necessarily like it, because they don't like to hear this, but financial markets generally are a get-rich-slow scheme. It's not about making amazing short-term decisions. It's about making lots of very sensible, boring decisions and allowing those decisions to compound over time. The way that financial markets work and the way that capitalism works is for capitalism to succeed, markets must, in the long run, go up. Otherwise, there's no incentive for me to invest in a business.
Yeah.
So capitalism needs markets and, assets to go up in value. So in knowing that, you come back to that comment that you've just said there, which is the idea that time in the market is better than timing the market. What we try and do is, I say, we're not going to win at this, and we're not going to have the best performance by making the most amazing decisions. We're going to win by avoiding the stupid decisions.
Yeah.
And that's something that Charlie Munger, who is kind of Warren Buffett's partner in crime, that's something that he always says is, that our job is about avoiding dumb decisions.
Yeah.
And so that's what we're trying to do is just avoid stupid decisions, make lots of very sensible decisions which compound in value over time and lead to, when you look back on a 5-year, 10-year, 15-year basis, produce a result that you could never have thought possible because of that compounding effect.
Okay, that's very interesting. And for an amateur investor, would you say just investing in index funds is the way forward, or is there any point in trying to sort of invest in individual companies and shares? What do you think?
So I think as an amateur investor, without possibly as much time on your hands as to make those investment decisions as someone like I have, I do this as a full-time job, all day, every day. I'm looking at these companies, I'm valuing these companies. I should have an advantage over you. This is a kind of game that I should win, between the two of us, which does suggest that I think placing large proportions of your money in direct equity investments yourself does come with a lot of risk. What I would say is that doing it with a small amount of money for your interest and for your learning is a really positive thing, and it's something that, like, maybe it's kind of not quite what you're talking about in terms of amateur investors, but often when we have kind of graduates come and interview for us, and I kind of say to them, look, give me an example of something that you've invested in. I'm not worried about the amount that they've invested, and I'm not even worried about them making money. The point is them learning from it and saying, right, so what did you learn from that? In a way, it's almost better if you lose money, right? Because then you go, let me assess that and say, right, why did I lose money there? What did I possibly get wrong? Or, what could I have done better? I see some benefit to investing in direct businesses for the purposes of learning and for the purposes of understanding what's going on, because I think financial independence and financial education and financial understanding is so important, and it's massively misunderstood, amongst our generation, I think.
Yeah.
And I think it's to do it for the purposes of learning and understanding is a good thing.
Yeah.
But there may be more sensible ways to invest large proportions of your money for the long term. And you mentioned passive investing there. I think generally it's a solid place to be putting your money. But, you have kind of passive investing and you have active investing. And broadly speaking, passive investing will track the markets. So it kind of buys every company that's in the market. And then you've got active investing, which says, well, actually, I'm going to pay someone like me to say, well, I think actually, no, this company is a better company or a better priced company than this company. So we're going to have a bit more in that and a bit less in that and a bit more in that and a bit less in that. And so that's kind of active investing. And then you pay a fee for that. I think for someone who maybe isn't able to do a lot of work in terms of understanding fund managers and understanding the funds that they put money into and the process that those fund managers use, passive investing is a pretty sensible way to put money to use. There's an interesting point on this, was in that book about luck and skill that was discussed in that book, which is this idea of, the book talks about the paradox of skill. And it's a really interesting point, right? So the idea being that as everybody becomes more skillful, luck becomes more important. Let's say cricket as an example. Okay, Don Bradman, maybe he was the only person in his day who trained 7 days a week for cricket, and he was the only person who had huge amounts of innate skill, and was kind of born to be a cricketer, and he trained loads. He is the most skillful person, right, in the game. Therefore, he is going to average the highest. Yeah. That's why you get an average of 99. But as everybody else starts to train 4, 5, 6, 7 days a week, and everybody becomes more skillful, then actually luck now becomes more important. So this book argues that's why you will never see someone average 99 in Test cricket again. Not that Don Bradman was way better than everybody else that's playing now, just that everybody else was way worse back then than all the people that were bowling at him. But that's interesting if you look at financial markets, because if you say, well, Warren Buffett, right, in the 60s, 70s, whatever, he was the only person who looked at, who had accounting skills, but also understood the kind of behavioral finance aspect maybe, but also was prepared to go through cash flow statements and really understood what long-term investing was all about. And everybody else was rubbish. Yeah. But then what happened is, as people made money, it attracted more people who were very intelligent and were prepared to work really, really hard, and were prepared to go and learn about all of this and to say, you know, how have they made lots of money? So the skill level of everyone comes up. So then you end up with luck becoming more important again.
Very similar to first mover advantage.
Yeah.
Markets.
Yeah, exactly. Yeah. Exactly.
You go first, and then obviously that could be a disadvantage as well, where, you know, in a business, for example, if you go first, make mistakes, the second one coming in will learn from your mistakes and be even better and then overtake you. Yeah. As we've seen in the internet era and everything, where brands like AOL and Yahoo to an extent diminished in comparison to Google.
I really miss Ask Jeeves.
Yeah, yeah, exactly. Shows your age.
But yeah, no. So that's so sorry. So that was kind of linking back to my comments on passive investing. Yeah, is we're in a world now where, you know, luck is quite important, and so that's why, you know, you go back to the point of process again, and so you say, well, actually, to achieve long-term good performance, I need to be in the few that has this really good, consistent process that I keep acting upon. But what's interesting about that is that maybe in our lifetimes, what might happen is that as everybody's realized luck is really important, then fees become lower. So people earn less money. So people are less attracted to go and work in finance. So then graduates will start saying, well, actually, why would I go and work as a fund manager when I can earn much more money being a, you know, whatever it is? Yeah. And so then you stop attracting people into finance.
But do you think that would happen? Because money as a topic is taboo, regardless of where you are in the world. And there is a clear lack of education in the school system, again, wherever in the world, of teaching investments, teaching how to invest, how to manage your money. How much of an impact do you think that has?
In terms of people wanting to go into finance?
Exactly, because you're saying the fees might go down and it may not be as attractive, but until and unless people are actually taught that at a young age, then the skill level will remain quite rare.
I think there is some truth in that, and I think there is, like, I do find it frustrating that my industry, I think probably every industry does this, or lots of industries, but I find it frustrating that there's so many acronyms and it is made to be quite difficult. And you could make an argument that that's a good way to make people continue to need your services. Yeah. So I think it's really important that we do address that as an industry, and that we do try. And I think as society, not as an industry, as society, like, I think it's really important that we help people to understand, but that it has to be two ways as well, right? Because the impression that I get a lot of the time is a lot of people don't want to understand it because they find it boring. I get a lot of, particularly when I go and talk to them about actually what you have to do, which is make those really boring long-term decisions. People just switch off and they're like, you know.
But I'm assuming you're speaking to people who are your generation.
Yeah.
You know, I'm more talking about
generation.
A younger generation, you know, even primary, secondary school kids. When they learn about money and how to invest in stuff, I think they'll be quite interested. And I think because there's culturally, it's been embedded in their heads, the older generation has been embedded in their heads that, you know, investments and stuff and finding the right companies to invest in is boring. Yeah. Hence, as soon as you start talking about it, they just turn around and say, not interested. Yeah. You know, there are easier ways to maybe earn a living or whatever it might be. Whereas if the cultures turn around and the younger kids are actually taught at a young age at school through the curriculum of how to invest, I think the conversations you'll have when they're 30, 28, 30, whatever, will be very different.
Yeah, I think that's a fair point. And it's not even necessarily teaching how to invest. Kind of, it's teaching them the mechanics of how capitalism ultimately works, you know, how the markets work. And I guess, like you say, maybe that will for a broader kind of cohort of people inspire a little bit more and ignite a little bit more passion, so that the conversations you have over the dinner table maybe are a bit more interested, rather than I kind of tend to be told quite rightly to stop talking about work because it's getting very boring.
There you go. So it goes back to my point.
Yeah.
Fair enough. Moving on to cryptocurrencies.
Okay.
Now, it's a big thing right now. It's been a big thing for at least 2 or 3 years now, where a lot of people have started looking into it, especially with the COVID situation and the pandemic and people being at home and thinking about not just having one stream of income, but multiple streams of income. What are your views on cryptocurrencies?
I guess the first thing to say is that I'm always aware with all my friends, I won't be telling them, don't do this, do this, don't do that, for a couple of reasons. Because it's not my decision, to be telling them how to invest their money. That's not for me to do. But the second thing is that there are 1,000,001 ways to make money in, the financial markets. And just because, I see my way as being right, it doesn't mean it is right. And, other people have found much better ways of making money, if you look at their records. So that aspect is, people can kind of do what they think is right. My view on it is that I'm cautious on it, I would say. We don't hold any cryptocurrencies in the funds, and it's not something we would own. If I kind of go back to the kind of like first principles of what we're trying to achieve, so there's two ways you can value any asset. Is either the value of the future cash flows that it's able to produce. So your cricket company produces X, Y, Z pounds over the next few years. I discount that back and I get to a price today. That's what I'll pay. If, that cup of tea starts spurting out £1 coins next year, then £2 coins the year after, then £4 coins, I'll try and work out those cash flows that I'm expecting and I'll discount them back to today. So you've got one way of valuing an asset, which is saying, I'm going to work out all its cash flows. I'll discount them back today. That's what I'll pay for it. The other way of working out the value of an asset is by saying, I think people are going to pay more for it in the future. So an expectation of what people will pay for it in the future. Now, I use the method that basically says, I want to use the cash flows and try and bring that back to today. So that's what moves me away from investments like Bitcoin. There's no cash flows. There's zero cash flow associated with owning a Bitcoin. I discount the cash flows back to today and I get zero. So your ownership of Bitcoin is purely based on what you think someone else will pay for it in the future.
Speculation, essentially.
Yeah. If I was being disparaging about it, it's occasionally called the greater fool theory. So it's saying I'm going to find someone that's a bigger fool than I am and find someone that's going to pay more and more and more.
But do you think digital currencies like Bitcoin and Ethereum especially, and the blockchain technology that they're used on and stuff, isn't having a digital currency ideal to sort of remove barriers to international markets? And then obviously that would encourage greater innovation and speed, and not having to deal with fiat currencies and banking systems and everything, and it's instant. Do you not think in the long term we will be in a place where the digital currency becomes the dominant currency?
So I do agree with you on a kind of simplistic level. I think that makes total sense and I can see us heading in that direction. But I think it's then a big leap to say, well, Bitcoin is the way to play that. So if we were able to gain access to that kind of technology through a listed business or that kind of thing, that would be a much more, in my view, that would be a much more likely way for us to play that and to try and get exposure to that and to try and own businesses that will benefit from that in the future. I don't think it's a direct step to say, because you think that's going to happen, you own Bitcoin or Ethereum. There's nothing to say that Bitcoin isn't made defunct next year for any number of reasons. Now, there's also nothing to say that that Bitcoin isn't the currency that is used for that world that we're talking about. So, but it does become more of a speculative position, which again, if you go back to what we're trying to achieve with those kind of compounding long-term decisions, is not what we're trying to do.
Yeah.
But again, none of this is me saying it's the wrong thing to do, and it's just not what we'd be doing.
Okay. We obviously live in a society of instant gratification. And it's something where people have seen cryptocurrencies and gone, okay, if I invested £100 or £1,000 in 2017, it would have gone up to whatever it would have gone up to in 2020 or whatever. Do you think that's what's really driving cryptos at the moment, more than anything else, which is data driven?
Yeah, I think there's a lot of speculative excess. And I think it is a slight warning sign in the markets that I think, that people are prepared to speculate to that degree. And I think it is a little bit of a kind of an amber light, I guess, when you start to see things like that and you start to say, well, hang on a minute, there's quite a lot of speculation here. We might be kind of quite frothy in the markets here, because again, like if I go back and say so interest rates are at 0%, right? The opportunity cost of me putting money into Bitcoin is to say, well, I would put it into the bank at 0%. So kind of like, that's why it's probably driving some people in there. Now, let's say interest rates in a hypothetical world go to 4 or 5%. Now the opportunity cost is 5% per year. Now that might change some people's decision if they say, well, actually, I can put £100 in the bank and be guaranteed £105 next year. Or I can put £100 in Bitcoin and maybe it will go up to 10,000 or maybe it will go down to 20.
But have you not been tempted to do that?
No, because I told you I'm boring. No, I told you because I make the same boring long-term compounding decisions with my money as I do with everyone else's. So all my money, it really is all my money is in the funds.
Okay, you haven't gone, okay, let me just put £100 in Bitcoin and just see how it goes. Leave it in there and just see how it goes, and let's have a look back at it in 5 years and see where it's at.
No, because the maths of the maths of compounding, right, is that if my £100, if I put it, let's in a hypothetical world, the fund maybe makes 5% per year. That doesn't seem unreasonable. It's totally hypothetical, and it could be a lot bigger or a lot smaller than that. But that'll be 105 next year, and then you've got 5% on that, so you're now up to £110.50p. And then you got 5% on that, and then you're getting up to 116-ish, and then you're putting 5% on that. And so 5 years' time, that's now £120, £130. Yeah. And then if that was £100 I put on Bitcoin here, and then £100 I put in Sporting Index there, and then £100 I did over here, all of a sudden you're starting to get to £300, £400, £500 that you could have put in the funds and compounded at maybe 5% per year.
Yeah.
And it goes back to that point of it. I see it as a get-rich-slow scheme.
Yeah.
It's highly likely I will miss out on some excellent, opportunities. I will...
But you're happy to accept that?
I'm happy to accept that trade-off to say that I am more likely then to achieve this kind of slow, steady, compounding rate of return year on year on year.
Yeah.
That's not to say by any means, by the way, that 5% will be 5% every year. That will certainly have drawdown years. It will certainly have a year of minus, 5 or minus 10 or whatever, it doesn't guarantee a positive return every year. That's not what we're trying to do. But, certainly more stability and less kind of volatility, I guess.
Yeah. Moving on to social media.
My favorite.
Yeah. I know it's a very, very much a favorite topic of yours. But do you think social media is making us unsocial?
Is social media making us unsocial? I think there are a couple of major costs, I think, for social media. There are some benefits, and I do get a bit of a bee in my bonnet about the costs to society for social media, but I do need to accept that there are some benefits, and there are lots of people who have created businesses from it, and there are lots of communities that have been brought together because of it, and there are people who are able to stay in touch with friends and family over the world. So it's not entirely one-sided, which is, on a Saturday when we're playing cricket together, that I like to make it out to be when I'm trying to rile you and other people up. But I think there are, so maybe if I point out maybe two of my bigger concerns, I think the first concern is the mental health aspect, which is the way that social media, in my opinion, is almost built to make people envious. That's my perception of it, is that people just put pictures or, statuses or whatever it is of the positive aspects of their lives. I'm not going to put a picture on Instagram of me waking up this morning at 6 o'clock to work, feeling, a bit groggy and desperate for my coffee.
Why not? Don't you want the world to know you're working at 6 a.m.?
Yeah. Well, I've just said now. So you only put the positive aspects of your life, and then that means that everyone looking at it only sees the positive aspects of your life. And that, I think, I'm not sure that's a positive thing, because then people who are perhaps lacking a bit of, maybe not confidence is not the word, but people who look at certain aspects of their lives and aren't happy, they then compare themselves to what they see on that screen, and they say, well, I'm not that skinny, or I've not been on that holiday this year, or, I'm not going on that boat, or whatever it is, or I've not had that amazing dinner. I'm terrible. And I think that's really dangerous. And
but does it then, again, similar to investing in money management and all that sort of stuff, surely it then purely comes down to the educational aspect of it, where academically kids need to be taught within the curriculum. Now, with social media and this sort of thing, it seems to be very sort of extracurricular activity, where schools will say, oh, come to the after school club to learn about this, rather than it being an integrated part of the curriculum, which it should be, in my opinion, so that kids can learn that when they do see something where there's a bit of envy involved, possibly a bit of jealousy, whatever it might be, how they deal with those emotions. And, it's natural for people to feel those emotions. Obviously, if they haven't been on a holiday for 3 years and they're seeing their friends go on holiday, they'll naturally feel like, oh, I want to do that. And mentally training them or teaching them how to deal with those emotions is quite important.
So I think, I'm not sure academia can keep up quickly enough with the rate of change of social media. And B, I think teaching how to deal with those emotions is incredibly difficult. Like that's hard to deal with. And so to teach kids how to deal with that, I'm not sure, there's lots of aspects that I would struggle to deal with there. And many other adults would struggle to deal with. So to then go and teach kids that, I agree, in theory, that sounds brilliant. Very difficult to do, I think, in practice. Okay, smoking, I use this analogy a lot, right? Smoking back in whenever it was 40s or something, people didn't really know it was that bad for you. My nan always used to talk about the fact that she smoked, and she didn't have a clue it was bad for you. She just thought it was a way for you to get together with your friends. She thought it was a way to, be quite sociable. She thought it was, she quite enjoyed it. She had no idea of all of the negative effects of it. And so maybe it's about teaching those negative effects. Maybe you're right, and making sure that people understand that. And we've done that with smoking. So maybe we need to do that a little bit better with social media. But that's the first aspect that kind of concerns me a little bit. The second aspect, which I think is concerning as well, is in building your own social media, all of us create an echo chamber, right? The amount of information that's available, we go and seek out information that agrees with our opinion. Like, it's confirmation bias. I'm always going to do it. Whenever I Google something, me and you have a debate about, I don't know, where the best place to go on holiday is. And I say Paris and you say, Frankfurt or something. I will Google, is Paris the best place to go on holiday? Without a doubt in the world.
Yeah.
And I'm pretty sure I'll find a yes. But the problem with social media is I think that you create that echo chamber. And so you start to just see everybody agreeing with your opinion, and then you post your opinion that agrees with that. And then you all kind of agree with each other, and you become more polarized.
Yeah.
So as society, we become much more polarized. So if I'm innately, I don't know, if my views are slightly left of center, I probably end up becoming kind of much more left wing.
Yeah.
Equally, if I'm slightly right of center, I'll probably become more right wing. And you end up with this, because I'm reading all of the same things over and over and over again. And, that I think is a real concern. And I don't know how you address that.
I think possibly one potential option could be that when kids are being taught this at school, they are taught to focus on things which will help them learn new things. So, for example, instead of subjective things like holidays, they learn more about, let's take investments into whether that's financial, properties, whatever it might be. And they go, okay, you want to open a social media account, focus just on, let's say, property investing. And then the sort of confirmation bias probably helps, because what they'll do is they'll end up taking action on those posts that they do in the echo chamber they've created. It's actually a positive echo chamber rather than a negative one where all they see is, all the other stuff that we've spoken about. And they will be surrounded by people who, let's say it's property investing. They'll be surrounded by people who are interested in property investing. They'll learn about investing in properties or finances or whatever it might be. Do you think that might be one way where academically in a school setting, they told, okay, pick a topic that you're really interested in and then just post about that topic on social media?
Yeah, I actually do agree with that. I think that actually implementing that is quite difficult to do though, because I think people will go and follow their friends as well. And they will go and follow Cristiano Ronaldo as well. Yeah. And they will go and follow, XYZ as well. So I agree with you, but I think it's a little bit harder to do. And an example of where I would say I do agree with you is I use Strava. So, and my girlfriend always says to me, well, you're on social media, like you use Strava, you post things on Strava. It's true. She's right. And these things are addictive. Don't get me wrong. They are addictive. I'm aware they're addictive, but also maybe I'm creating this excuse for myself, but I kind of see it as that positive echo chamber because it forces me to go out and exercise. Yeah. And because I feel like I'm competing with the kind of 4 or 5 friends that I have on Strava. Yeah. And, I see them exercising and I go, well, I suppose I better do some. Now the problem with that will come is you'll say quite rightly, well, do you then start to feel bad about yourself if you're not exercising and other people are? And do you start to then over exercise? So, my view is kind of flawed in that, I'm also part of it. I'm not perfect by any means. Yeah. And it's easier to criticize than it is to actually kind of deal with the issues or kind of, solve them yourself. But
you're saying it's difficult to implement, which I completely agree with, but it's not necessarily micromanaging the implementation of it per child, but it's embedding the thoughts and the mindset into kids that social media can be used for productive gains. Mm-hmm. And then they can naturally, they'll still go out and follow your Cristiano Ronaldo's or whatever, but they will at least have that in the back of their mind that they've been told at a young age that use social media for good. Yeah. And you don't need to implement it in a very particular way, but at least you're embedding it into their mindset that in the long term, it might come to fruition.
Yeah, I definitely, I see that as an option of ways in which it can be addressed. But I think it seems to me that we're kind of in agreement that in some way, shape or form, the use of social media has to be addressed. Yeah. And I don't think it is right. I definitely don't think it is right that it's just banned. Because as I said at the start of this, there are a lot of benefits to it, definitely. And I don't think it's right that anyone comes in and says, right, no, you're not using it anymore. Yeah. That's not how to deal with it. Yeah. And maybe it is what you're talking about, that actually education of how to use it more productively is the answer. I do think that what you're suggesting is very difficult in practice, but it doesn't mean that we shouldn't try.
Yeah. You've touched on this already, but the change of technology and the pace of technology changing nowadays, the people making the legislative decisions, whether that's around social media, whatever it might be, haven't even fully understood maybe Web 2.0, let alone now we're moving into a world where the metaverse and Web 3.0 is coming around. I would probably say that that's probably the biggest barrier of implementing change and getting the right legislation in place to work with social media, because the people implementing the change, they don't fully understand. I've seen a few US Congress settings and stuff where the people asking the questions, they're interviewing or they're asking questions to Mark Zuckerberg and people like that. And he's having to explain the very basic things. So the understanding's not there. And the way the technology is moving, it's just going to get even faster. What do you think of that? I mean, how would you implement legislation or curriculums and education around things like social media, investing, whatever it might be?
Yeah, I mean, I think maybe in government across the world, people who are experts in that field, need to be employed in a kind of on a consultancy basis, and it's something that I've kind of said before, and I probably wouldn't get on my soapbox about this too much because it's not something I've researched massively, and it's not something I know hugely about. But my understanding is that in government a lot, it's generalists who tend to be advising on decisions, who, those generalists will go, and their job is to find out a lot of the information from the people who they can, and then to, get that information and feed that in to advise on the decision. Maybe those people who are the health secretary or whatever it is, maybe that would be better served by somebody who has worked, as a practitioner, or, the closer that the decision making can get to, the someone who's a practitioner or someone who's an expert in that field, I think the better.
Yeah.
Because I totally agree. And I wouldn't know. That's kind of the point, is me saying, I don't really know the solution to social media because I don't really entirely understand it myself. So how could I advise or make decisions on what the best thing to do is?
Yeah.
And the people who can are the people who really know it inside out. So the closer that you can get them to the decision-making process, the issue that you have there is that those people generally are financially incentivized for that thing to keep doing what it's doing.
Yeah.
So then how do you avoid that problem? It's tricky.
Just looking forward now, how would you advise someone just getting into investing, a 20-year-old, let's say? What advice would you give them when it comes to investing into finance or whatever it might be? Yeah.
Start as soon as possible. And it really doesn't have to be a lot of money, because it's that thing that I spoke about earlier, which is the idea of kind of compounding. Because, the sooner that you can start, the sooner you can benefit from that. And, you'll be amazed at how much that money can grow over long periods of time if you just tuck it away. And, we mentioned about passive investing. It's a very sensible way to put money to use. There's lots of ways that you can get money to work in the markets, in platforms like AJ Bell or Hargreaves Lansdown. That kind of thing tends to be better for those kind of long-term investment funds, perhaps, rather than some of the trading sites that you might see advertised a bit more heavily. But yeah, get started as soon as you can, really. It's one of those things like, I think it's asparagus that maybe takes like 8 years to actually produce fruit. And I think they always say maybe asparagus farmers. Yeah. They always say it's one of those things that you always wish you'd started last year.
Yeah.
And I think that's the case with investing. The sooner that you can start and just, tuck money away and, kind of be sensible about it and just keep kind of putting a little bit in, I think the sooner the better.
Yeah, I think it's, there's also, I may completely butcher this, but the Chinese bamboo tree, I think it is, where you have to water it for 5 years before you see any growth. And then within 5 or 6 weeks, it's grown to 10 feet or
there
something
you go.
Crazy like that. So it's all about patience. And I think this has been really good to do this with you. And the one thing I've learned is compounding. Really focus on long-term gains and just go slow and steady. In a world where, like I said, instant gratification is a major thing, it's very difficult to actually go the other way and just go very sensible, slow and steady, and make as few silly decisions or stupid decisions or whatever you want to phrase it as possible, and just go sensible. And then the other thing, obviously, especially for youngsters and even older people, I guess, is it's probably the greatest opportunity anyone has to learn about investments. And with the information out there, social media, YouTube, whatever it might be, there's enough out there for you to learn yourself and at least start. That's the main thing that I've learned.
Mm-hmm. Absolutely. Yeah, it's been a pleasure. Thank you very much, Diva.
Thank you very much for doing this with me.